Hello traders, I am Peter, and in this video we are going to cover the different instruments that are traded on financial markets. So what are we going to cover this time? We will take you through the brief introduction of stocks, options, currency pairs, also known as Forex, and also about equity indices, commodities, and cryptocurrency. All these instruments are offering unique specifications and ways how they are traded, which is exactly what we are going to explore in this video. Stocks are first on our list. A stock is a security where the owner of a stock becomes a shareholder of the company. A shareholder has different rights. For example, he or she is entitled to participate in the profit of the company in form of dividends, but also to participate in the management of the company. In some cases, shareholders are also entitled to vote at the general meetings or participate in the liquidation balance of the company in events of liquidation. This all depends on how many stocks you own and what rights you have with them. So why are stocks traded in the first place? Main reason is for companies to raise capital by selling shares on the stock exchange. This of course attracts investors that want to evaluate their resources. The company's liabilities are guaranteed by shareholders only by their stake, which is the share price multiplied by the quantity purchased. We distinguish two types of stocks: paper shares, which are the physical documents, and dematerialized shares that are entered in the electronic records. These are not used much nowadays. So how can you trade stocks? Stocks are traded in many forms. You can trade them as CFDs on our FTMO platform, or you can trade them at stocks exchanges. In recent years, trading stock options also rose to popularity. All of these are traded entirely online. Example of stocks can be Microsoft with ticker or shortcut MSFT, or Tesla with ticker TSLA. For these popular companies with large market cap, we use term blue chip stocks. They have stable growth and paying dividends on regular basis. Opposite to these are paper stocks, small companies that are trading in few cents or dollars and experience much higher volatility, which can bring significant gains but also losses. Options are the only financial instruments that is not available for our FTMO traders. They are very complex products, but having a basic knowledge about them is something every trader should have. Option contract gives the buyer right, but not the obligation to buy or sell underlying asset, oftentimes stock, at specified strike price prior to or on a specified date, depending on the form of the option. In a real-life example, imagine you want to buy a house. The cost of the house is $100,000. You go to owner and you buy an option contract which expires in 3 months. This means that in time of the expiration, you have a right, but not the obligation, to buy that house for $100,000. If in 3 months, the price of the house rises to $110,000, you just save $10,000 on the purchase, because you will execute your right of the option to buy it for $100,000. And then, as a clever investor, you sold it for $110,000. You just gained $10,000 profit. But if the price of the house falls to $90,000, there is no reason to buy that house for $100,000. So you will not execute the option. Because you don't have obligation to buy a house, you need to give something to the house owner upfront. This is called premium. So for this case, let's say you had to pay $2,000 of premium upfront. This is eventually your whole risk on that investment. If price of the house rise by $10,000 in any time in that 3-month period, you can buy the house for $100,000 minus $2,000 premium paid, so you just made $8,000. If price of the house drop by $10,000 in any time in that 3-month period, you don't have to buy the house, but you lost $2,000 in the premium, because there is no reason to buy a house for $100,000 if its current worth is only $90,000. This was just a brief explanation of how options work. Because you can buy and sell options at the same time, you can create very complex strategies that can profit when markets are not moving. In options terminology, calls and puts are used instead of longs and shorts. Stock options are the most popular, but there are also Forex, futures, bonds, or commodities options you can trade. Currency pairs, which all knows as Forex, is the biggest market with 5.3 trillion daily volume. Forex pairs consist of two currencies, where one is called the base currency and the other is the quote currency. We trade currencies in such a way that we speculate on the strengthening one currency against the other one. Simple example would be something that will happen to all of you. Every time you go to the vacation to foreign country, you need to exchange your currency for the foreign one because price of those currencies constantly fluctuate. After a few weeks, when you return from vacation, the exchange rates are slightly different. Of course, when you are dealing with only few hundred or $1,000, you rarely notice the difference. But buying or selling 100 or millions of currencies to profit on future exchange rate change can have a huge impact. From end of March till start of August, currency pair euro-dollar rise approximately 10%. This means that $100,000 position that is in the forex world called one lot, you would make $10,000. Most of these moves are heavily fundamentally driven as all the currencies react to world news and events. We divide currency pairs into three categories. Majors, what is Euro, Great Britain pound, Japanese yen, Canadian dollar, Swiss franc, Australian dollar and New Zealand dollar, all paired with United States dollar. Crosses, which are all major currencies but paired with each other instead of dollar. So for example, Euro and Canadian dollar, or Australian dollar and Japanese yen, or Great Britain pound and New Zealand dollar. And then exotics that are pretty much all the currencies from the world, such as Turkish lira, Swedish crown, Polish zloty, etc. Forex is characterized by high liquidity and often volatility too. That depends on the fundamentals a lot. Price usually move 1 to 2% every day, but small percentage movements are compensated by high leverage that broker offer. Forex is going to have its own category, so we will return to it later on. Equity indices are some of many different instruments traded on exchange. The equity index is an indicator of the development of a given segment or economy of the country as a whole. Most often, we have equity indices that reflect the value of shares traded on given stock exchange. For example, the most famous stocks index of the Frankfurt Stock Exchange is DAX, which is composed of a share priced by 30 most important selected German companies. So DAX is BMW, Adidas, BASF, Bayer, Lufthansa or Siemens. United States indices are the one that are most popular, namely Dow Jones, S&P 500 or Nasdaq. The value of indices varies based on the movement of all shares that are contained in the index. In general, indices are stable investment instruments. As a rule, they are not volatile just as any individual stocks titles can be. Therefore, investment in the indices is gaining increasing popularity among investors. Although indices are less volatile instruments, they are traded through CFDs and futures with high leverage. Thanks to that, they offer a lot of intraday and swing opportunities, and there is a lot of traders who were able to make their trading career trading only a one index on intraday basis. Goods that are traded in the markets without quality differences. Deliveries from different suppliers are mutually substitutable. For example, a commodity cannot be a car which is produced by many different means at different prices. The most well-known traded commodities are crude oil, gold, natural gas, but also coffee, corn, or oranges. There are two types of traders on the market. The first, also being a minority, only speculates on a price development, while others are really buying that particular commodity. For example, Starbucks arranges coffee deliveries in advance for the year 2020 through the commodity exchange. For commodities, we need to take greater risks. Their price depends on climate change, global resources outages, trade wars, or many other factors. It is important to understand that some commodities are correlated to the certain currency of a particular economy. Correlation of price development between currency pairs and commodities are, for example, crude oil in Canada, gold, iron ore to Australia, dairy products to New Zealand, or natural gas to Qatar. There is also a need to monitor world affairs, macroeconomic data, population growth demands, or any other factors. Same as equity indices, two most popular ways to trade them are through CFDs or futures. Cryptocurrencies are a type of digital currency, or in other words, electronic money. The biggest problem, or for someone else, the advantage, is that electronic money is not regulated. The most famous is Bitcoin. Others are Dash, EOS, Ethereum, Ripple, or Litecoin. The price changes of cryptos are very steep. For example, Bitcoin in 2018 ranged from $3,000 to $19,000. You can trade cryptocurrencies in the spot market, but also as CFDs in our FTMO platform. Recently, futures and option contracts for cryptocurrencies start to gain more popularity as well. Thank you for your attention, traders. Now, as we know different instruments, we can take a look at trading terminology, which is going to be a topic of our next video. If you have any questions, or you have not understood something again, or you are just interested in something, just let your comment down below. Don't forget to subscribe our YouTube channel. And thank you for your attention, and I wish you steady study and see you next time.